Hello, everyone. Welcome, Apple employees. Um, Hopefully, you're here for this webinar, which is 5 steps for Apple employees to make the most of their Apple RSUs. So let's go ahead and get started. I'm going to tell you a personal story about why I'm here, and then we'll get into the heart of the presentation. By the way, my name's Tom Lowe, and I want to share a story with you, which is I want to bring you back to the late 90s. And I worked at a .com, and I remember it was like it was yesterday. I could hear the sound of people celebrating, the sound of champagne corks popping, and everybody happy, very happy. And that's because we had just done what every company in the late 90s wanted to do, every startup, which we had gone public. So it was a very happy day. And then as each day, week, month passed, we got happier and happier because the stock kept going up. And I realized at a certain point that I might be able to reach financial independence a lot earlier than I thought I was going to. At this point, I was in my late 20s. If the stock kept going up in that way. So now, for those of you who know history, you know that the dot-com bubble burst. So I was at a .com, and we actually ended up, the company shut down. And so I had a ton of equity that I held until it went to zero. And a couple of important things came out. One is I realized I didn't really understand how my employee equity worked. And so I started to educate myself. And that actually started me down the path of making a career change into financial planning more than a decade ago. So I worked in tech for about 20 years and then made the career change because I had started that education with that event. And the reason I'm here today and the reason I built this firm is because I want to make sure that people like you, tech professionals, Apple employees, are able to make the most of their equity to reach their financial goals. And they don't end up in a place where I ended up back in the late 90s. And that's why I became a financial planner, to help people like you. And that's why I built this firm. So hope that was helpful for you to understand why I'm here. Let me share some slides with you. Okay, so this is, as I said, 5 steps for Apple employees to make the most of their Apple RSUs. So again, this is for educational purposes. You should always talk to your professional. So here's what we're going to cover today. I'll tell you a bit more about my background, and then I'll walk through the 5 steps for how you can make the most of your Apple RSUs, which is step 1, understanding how they work. Step 2, avoiding a surprise tax bill on your Apple RSUs. Step 3, determining if you have too much in Apple RSUs. Step 4, deciding when you should sell your Apple RSUs. And step 5, plan what should you do with the proceeds once you have those. So I expect this will take about 30 to 45 minutes. We'll have time for some Q&A at the end. Now, if you, I know some people are, I've done a number of these, and I know some people are perfectly happy to ask in that forum, but some people also prefer to have a more private setting. So I'm happy to give everyone the chance who wants to talk about their specific situation to schedule a free virtual consultation with me. You can put time on my calendar. We'll hop on a Zoom and we talk through whatever questions you have. So let me um, put this up there. So you should have on your screen now a big red schedule now button. So if you click on that, again, it'll just take you to my calendar. You can pick a time. We'll have a Zoom conversation and I can answer questions about your specific situation. So free, no obligation. Okay, so let's get started here. So here's my background. And I think the key thing to know is that I've been doing this for a decade plus, and I built this firm, and I specialize in helping tech people with equity, like Apple employees who want help with ongoing financial planning, investment management. So that's because I specialize in that. I have a number of Apple employees who are clients. I understand your situation well and went through it myself because I worked in tech for about 20 years. So let's start with step one. Let's understand how your Apple RSUs work. Okay, so your RSUs are simply compensation in the form of Apple shares, right, that vest over time. And the typical vesting schedule, which means how do you own these things, is you vest every 6 months over 4 years. So every 6 months, you get some portion of your 12.5% of your original grant, and every and that's how it works. And at the end of 4 years, you have 100% of your initial grant. Now, it's important to understand the tax treatment, how these work. So when you're granted, which is typically when you start employment at Apple, you don't have to pay any tax, $0, right? So there's nothing upon grant. Now, what happens when you vest is that you pay ordinary income on the fair market value of that stock when it's vested. So you can it's treated just like your salary. You get taxed right away, and it's a value on the day you actually vest. So let me give you a little more detail. So one way I help clients think about RSUs is you can view it or think of it as a cash bonus in the form of Apple stock. And that's because you are taxed immediately as soon as you vest, which is different from, for example, incentive stock options. So sometimes clients get those mixed up in their head, but they are treated very differently from a tax perspective. Okay, so again, as soon as you vest, you get taxed ordinary income just like a cash bonus. Okay, now to help you understand that, let me give you two versions how you could get um, getting your RSU. So let's say the first Apple RSU version. So Apple gives you $100,000 in RSUs, okay? And then what happens is Apple immediately sells, let's say $40,000 of your RSUs to cover your taxes and any other withholding you may have. So they sell that, and then they leave you with, let's say, $60,000 in Apple RSUs. So what ends up in your account, day you vest, is, let's say, $60,000 of Apple stock. Okay, let's take a look at the cash bonus version. Let's say Apple gave you instead a $100,000 cash bonus. Okay, and then they take the cash bonus, they take out their taxes and other withholding, just like they do for your salary. Let's say they take out 40,000 and you get $60,000 in your checking account. So now you got 60,000 in your checking account. And then let's say you go out into the stock market and you buy $60,000 worth of Apple stock using that cash you now have in your checking account. You end up you own $60,000 of Apple stock. So in both the Apple RSU version and the cash bonus version, you end up in exactly the same place. You own $60,000 of Apple stock in both cases. So that's why it's helpful to think about it as, hey, it's really a cash bonus. It's in the form of Apple stock. Now, the reason that's helpful to think about is because the next question is, I ask my clients, and you want to ask yourself is, if Apple gave you a cash bonus today, would the first thing you do with that cash be to go buy Apple stock? And if you hold your Apple RSUs, then it's the same as buying the stock at the current price. So if the answer to that question is, and in fact, most of my clients will say when I ask the question, no, that's not really the first thing I do with it. Then you should consider selling your Apple RSUs. Okay, because remember, it's the same as cash bonus. Now, when you sell, really, it's going to depend on your specific situation. You should talk to your professional, your financial goals, how concentrated you are, and we'll talk through some of those things in a little bit. But really, that's the first question. Ask yourself, hey, cash bonus today, would the first thing I do be to take that cash and go buy Apple stock? If you say, yeah, that's absolutely the first thing, then you may want to hold on. But if not, then you at least consider selling. So in general, I recommend you sell as soon as you vest because there is no tax benefit for holding. All right. It's treated just the same as cash, just the same as your income. Okay. Now, sometimes clients say to me, oh, well, if I hold it more than a year, then I will get the long-term capital gains tax treatment, which is a lower tax rate. But that's a misperception, and I'll tell you why. Let's say you exercise. I mean, you vest your RSUs today. Let's say Apple's $100 to keep the math simple, and then you hold it more than a year. You sell it for $110. Then the $10 gain, the difference between the 110 and the 100, that does qualify for long-term capital gains, which is the highest federal rate's 20% versus the ordinary income. The highest is 37%, right? Okay, so you get that long-term capital gains on that $10. However, let's say you go back, you vest your RSUs. Well, forget the RSUs. You just take $100 of your cash. You go buy an Apple share, Apple. Okay, you hold it more than a year. You sell it for 110. That $10 gain is also treated as a long-term capital gain. So there's no difference between your RSU, holding your RSU, and going and buying the stock. Okay, so that's why there's no tax benefit. Okay, now that's how your RSUs work. Step 2 is avoid a surprise tax bill on your Apple RSUs. So I have a bunch of clients go through this. So as we talked about, Apple will withhold for taxes on your RSUs when you vest, and then they'll leave you the remaining shares. The question you want to ask yourself is, have taxes on your Apple RSUs been under withheld? Okay, remember you pay ordinary income tax rate on the fair market value of the RSUs when you vest them. Now, typically Apple or all companies, the standard withholding is 22% federal tax rate, okay, up to a certain point. Now, let's say, for example, you are in the 37% federal tax bracket, but Apple's withholding at 22%, then you're being under withheld 15% for your RSUs. So that means if you vest, say, $100,000 worth of RSUs, you because they've under withheld, still owe the IRS $15,000. Okay. So you're going to have to pay that come April. And so what happens is um, Apple employees don't realize this, that they're being under withheld. They get to April of the following tax year and they get hit with this a huge surprise tax bill. And they're like, what happened? And the reason why is because you have been under withheld. So this is something you want to be aware of. And the way to avoid this, so I do this with my clients, is ideally you work with a tax professional, right? And every quarter you make quarterly estimated tax payments so that if you happen to be under withheld, you're going to make estimated tax payments so that you are paying what you owe, and you don't have to wait and get surprised come April 15th. Okay. And then you should, once we identify, okay, you need, you're under withheld, sell enough RSUs to cover the taxes and set aside as a tax reserve. Either pay it quarterly or have it held in cash so that you can pay the taxes when they come. Okay, so this is how you avoid a surprise tax bill on your RSUs. Okay, so step 3 is determine if you have too much in Apple RSUs. So I talk with clients about this concept of concentrated stock. And that just means you own too much of a single company stock. And my general guideline is if it's more than 20% of your investable asset. Okay. And so when you compare it to a diversified portfolio, there's just a ton more volatility and risk when you hold a highly concentrated stock position. Okay. And to illustrate this, I want to go back, tell you another story, which is about a company called Enron, which is a company in the 90s that was an energy company that everybody loved, both as a business and as a company and as a stock. And you can see here, stock went all the way up to $90 by the early 2000s. And then some bad news came out, which was there was some fraud, there's accounting scandal. And within a matter of months, it dropped to nothing. Okay. Now, the concentration risk was that there were employees who had almost all of their retirement savings, all their net worth in Enron stock. And that's because the company 401k, you had a choice to invest in Enron stock. Company match was Enron stock. You could purchase Enron stock. And so, as I said, once this happened, there were Enron employees who had all of their net worth, all of their retirement accounts in Enron, and they lost it overnight. So they're employees who lost hundreds of thousands of dollars, if not millions, in a matter of months. Okay, so that is the risk of having too much concentration in a single stock. If something bad happens beyond your control, and all of your net worth is in a single company stock, you could lose all of your net worth and or all your retirement savings. So question is, all right, well, how do I figure out if I have too much in Apple? Okay. So let me walk you through the steps. Step 1 is you just calculate the total value of invested Apple equity. So all your RSUs, and if you happen to participate in the employee stock purchase plan, that, and if you happen to buy it on your own, the value of that. So you just take the total value of that equity. Okay, come up with a number. Step 2 would be you calculate the total value of your investable assets. So that would be savings, investments, your retirement, 401k accounts. You add it all up. You add the value of your invested equity. And step 3 is you just take the value of your Apple equity, you divide it by the total value of investable assets, and step 4 is you have your and you get your concentration, percentage of concentration. Step 4 is if your concentration is greater than 20%, you're highly concentrated, as my general guideline goes, and you should think about diversifying. So quick example here is, let's say you got 4,000 vested Apple RSUs, $100 a share, keep the math simple, $400,000 worth of Apple. Say you add up your savings, investments, 401ks, that's $600,000 total, excluding the Apple. You add your Apple of 400,000 plus the 600,000 gives you $1 million in total investable assets. You divide your 400,000 of Apple by your $1 million total assets, gives you 40% concentration. 40% is greater than the 20% threshold, means you're highly concentrated. So you should think about diversifying. And as I said, I specialize working with Silicon Valley tech people. It is extremely common to be highly concentrated. I have clients who come in who have 50% concentration, 70, 90, 95% concentration. If you're at a successful startup, or if you've been at a place like Apple for a long time, there's a really good chance you could be highly concentrated. And that's something you should think about because of what we just talked about in the Enron example. So again, this is, I know, general advice on how to determine if you have too much in Apple stock. Again, if you want to talk about your specific situation, feel free to click on the schedule now button and set up time with me. We can talk about your specific situation. Okay, step 4. Decide when you should sell your Apple RSUs. Okay, this is the biggest question that a lot of my clients deal with and a lot of other Apple employees. So here is a way of thinking about it. Let's say if you have a bunch of Apple RSUs, okay? The first step is I would sell immediately to cover any what I call valid near-term cash needs, okay? That means things you have to pay in the near term. Near term is the next, let's say, less than a year or two. So for example, if you have taxes, like we talked about in the RSU example, you owe taxes, go ahead and sell so you got the cash so you can pay your taxes because you're going to have to pay them now or in April. An emergency fund. So emergency fund is if you have an emergency like a medical, big medical bill, job loss. Clients I typically have put aside 3 to 6 months of living expenses, enough to cover living expenses. So if you don't have one, then I think it's reasonable to sell and build one immediately. Or let's say you're going to buy a house. Okay, you're going to get the down payment. If you're going to buy the house in the next, in the near term, you want to have that in cash. Okay, you don't want to have it in something like a stock, Apple stock, because it could go up or down. And you want to make sure you have the cash so you can buy the house when you want to buy it. Okay, so that's the first thing. The next thing is I would think about, decide if you want to keep a certain percentage of your Apple RSUs over the long term. You may have plenty of clients who say to me, I believe in the long-term future of Apple. And so if you do, that's fine. You can hold on to some. I would recommend to keep something like at most 5 to 10% of your investable assets in the stock. But let's say you say, okay, yeah, I want to keep some. I'm going to keep 10%. So take your RSUs, whatever you've sold, whatever's left over, carve out 10%. And then the remaining 9%, let's figure out how to sell and diversify. So there are a few specific ways I suggest clients think about selling those remaining shares. Okay. Um, the first one is sell immediately. Okay, that's simple. Uh, and so window opens, you sell everything that you're able to sell. Um, that keeps things very simple. Now, most of my clients, when I suggest that one, they're not that comfortable. And the reason why is um, they don't want to sell at the wrong time. Okay. So the next two ways are sell over time on a schedule, uh, which simply means, let's say you decide I'm going to sell 25% a quarter over the next 4 quarters. So every time the window opens, I'll sell 25%. I won't worry if the price is high or low. I'll sell it. And then um, the second version, I'll talk through in a bit, but the benefits are a couple. One is you're not going to pick the wrong single day when the price is at a low point, right? Because it's going to go up and down and you'll get multiple chances. The second benefit is you can spread your tax over multiple years. So you can spread it over more than a year, a couple of years, a few years, however long you want to take. But the benefit of this is it takes a lot of the emotion out of the decision. So instead of you getting to the window opening and you thinking, huh, oh, is the price high enough? Maybe it'll go higher. Or it drops, oh, it's kind of low. Should I really sell? If you have this puts it on autopilot. So you know next quarter I'm gonna sell 25%. Doesn't really matter if the price is high or low. What I think I'm gonna just sell it. Okay. Next quarter, you sell 25% more, and so on. So again, you're just trying to remove as much emotion as you can, and you know you need to diversify, and this is a way to get you diversified. So the other version of this, you sell over time on a schedule, but in one other thing, Dad, you can do that over any time frame. So 10% a quarter over 10 quarters, you know, however long you want and you're comfortable with, you can figure that out. So the next version is sell over time on a schedule, but sell more when it's higher and less when it's lower. So what that means is you can set um, uh, price bands. So let's say um, you can say today, okay, if if Apple stock is greater than $150, I'm going to sell 50%. If it's between 100 and 150, I'm going to sell 25%. If it's less than 100, I'm going to sell 15%. Okay. And so you set your bands, and then wherever the price is, when that say quarter comes, you sell that percentage. Okay. So again, in this lets you sell more when the price is higher, 50% when it's more than 150, and less when it's lower, 15% when it's less than 100. Those are just examples. Okay. You would need to figure out what price bands make sense for you and what percentage you're comfortable with. Same thing, putting it on autopilot, except there's a little, the difference is you can sell more when it's higher, less when it's lower. So those are the three ways that you can think about selling your Apple RSUs. Okay, so step 5. All right, plan what should you do with your Apple proceeds. So once you sell or start to sell your Apple RSUs, what should you do? So ideally, you develop a financial plan with both your near term and your long term goals. So then you understand, okay, how can I use these proceeds to help me reach these financial goals? So that's why clients work with me is we build a financial plan so that they can figure out, okay, here are the near-term goals, here are the long-term goals. Near term, I want to buy a house. Long term, I want to retire. How can we use the Apple RSUs to get to those goals. Okay. But you can do this on your own. Now, once you have those goals, plan and you have those goals, you want to understand, first of all, the time horizon for each of those goals. So, near term and long term are the key differences. So, near term, I'd say less than a year or two. And so, examples of that could be taxes. You're going to have to pay in April, an emergency fund. You need it now, and down payment, you're going to buy in a year or two. Long term would be goals that are more than 2 years. So, for example, saving for college for my kid, retirement. So, that's the first step. So, think about your goals and the time horizon. The next step is to understand your risk tolerance. So, that is how comfortable are you uh, with risk, meaning that stocks will go up and down. If you understand that and it's not a big deal, then your risk tolerance may be high. If whenever the stock market goes down, you can't sleep at night, that means your risk tolerance is likely low. But you want to think about that because whatever um, decision you make, you need to be comfortable with. Okay, you want to be able to stick with. So, based on your time horizon of your goal and your risk tolerance, you want to decide on some what we call asset allocation, which is just what mix between stocks, bonds, and cash. Okay. And in general, for near term goals, that means things you're going to need, like I said, less than a year or two. You want to hold it in lower risk investments. And lower risk investments are bonds, for example, or even cash, right? So if you know you're going to have to pay taxes in April, put it into a highly liquid, safe account like cash in a savings account, right? So that when April comes, you will be able to pay your taxes. You're not going to have to worry about um, the value dropping 20, 30% by the time April comes. And then long-term goals, you want typically some mix of stocks and bonds. Okay, and it depends in part how far away it is, time horizon, and then your risk tolerance. Okay, in general, the longer your time horizon, so if you're going to retire in 30, 40 years, that's a long time horizon. And you have the higher your risk tolerance, I'm comfortable with risk, I'm okay losing. Then you can take more risk and you can invest a higher percentage in stocks. And a very simple rule of thumb is you take 110 and you subtract your age. That should be the percentage you invest in stocks, okay, for retirement, for a long-term goal. So, for example, if you're 40, 110 minus 40 is 70. So 70% stocks, 30% bonds would be a reasonable way of thinking about it. You want to ideally, again, um, understand your specific situation better, but that's a way of thinking about it. So for retirement, for longer time horizon goals, in general, you want to invest in a broadly diversified, globally allocated, low cost portfolio of stocks and bonds. So, broadly diversified just means different asset classes, and globally allocated means different geographies. So, for example, you want US large cap stocks, US small cap stocks, you want international stocks, emerging market stocks, you want US bonds, international bonds. That's broadly diversified, globally allocated. Okay. So that's how to think about investing your proceeds. Okay, so let's talk about next steps. Um, Again, as I mentioned before, feel free to schedule a free virtual consultation to answer your specific questions about your Apple RSUs or any financial planning questions you have. You can click on the schedule now button, or you can go to this URL, and you can, as I said, it's straightforward. You will get my calendar. You can put time on it, um, for a half-hour Zoom call. We'll talk, and you can ask me your questions. Now, we're going to have a couple of time for a little bit of Q&A, but before that, I want to just tell you one more story, my Yellow Jacket story. So, a few years ago, we had Yellow Jackets in the backyard. My wife said to me, "Hey, honey, can you call an exterminator and have him take care of the Yellow Jackets?" And I said, "Honey, I can take care of that myself." So I went out there in the backyard. I had some spray for Yellow Jackets, wasps. Started spraying. Next thing I know, I had a dozen Yellow Jackets all over my head, dinging me, and I ran screaming. And in fact, I was so uh, uh, disoriented. I ran into our house to find my wife, but I ran through our closed screen door. Anyway, she ended up hosing down my head, got all the Yellow Jackets off, and I called the exterminator, and he took care of the Yellow Jackets. Okay. So the reason I like that story is that sometimes you think, "Hey, I can do this myself," but sometimes it makes sense to hire a professional who does this every day, and knows what they're doing, and that's the best way to get the job done right. So, let me take got a couple minutes for Q&A. Um, and if we don't get to your question, then you can just email me, tom@bestofinancialplanning.com. And then also, there should be an option to just uh, drop your question in. If we do, we'll get back to you by email within uh, typically within 24 hours or so. Okay. Okay. So I see the question here. Question here is, how do we specifically avoid the tax surprise? Um, so ideally, you hire a tax professional, and they can run your estimated taxes each quarter. This is what I do with my clients typically, and they'll be able to tell you specifically, okay, um, you're under withheld. You need to pay X dollars in estimated taxes this quarter, and then you should be in good shape. And by the time you get to April, if you paid your estimated taxes each quarter, then you likely won't have any surprise um, when April rolls around. Okay. Now, if you're a do-it-yourselfer, you're doing your own taxes, then you could do the same thing as you go into TurboTax or whatever software, put in your data. And if you're comfortable doing that, come up with, all right, here's what my estimated taxes are. You can pay those. Or even if you don't want to do that, you can also make sure you sell RSUs or have cash in a tax reserve, again, like a savings account or something, that, hey, let's say, for example, I calculate I owe $15,000 in taxes this quarter. I sell RSUs, I get 15,000 in cash, I stick it in a savings account. I do that each quarter. When April comes around, um, I will have cash set aside to cover those taxes. And hopefully the calculations have been done right. So ideally tax professional, but if you do it on your own, then sell and set aside cash in a tax reserve. Okay. Another question is, okay, Apple employees, any other um, financial planning tips? So actually two other things I want to highlight for Apple employees that you should be aware of beyond your RSUs. The first is the Employee Stock Purchase Plan, the ESPP. Okay. And the way it works is you get a discount as an employee um, that you can purchase the stock at. And it's typically a 15% discount off the price at the beginning or end of the period. If you get the discount, and if you are willing and able to sell that shortly after you make the purchase, then that makes a lot of sense because um, you're getting the discount and you can, in some ways, if you're able to sell it soon thereafter, you're able to have a really good chance of locking in that gain. If you sell, you can lock in that gain from the discount. Okay. The second thing to be aware of is there's something called a mega backdoor Roth, which your normal 401k um, has a certain dollar limit you can contribute every year. The short version of the mega backdoor Roth, which Apple offers as a benefit, is it enables you to save a lot more, and you can have it saved in a Roth account, which is an after-tax account, meaning that the dollars you put in, if they're in the Roth, normally in your 401k, your pre-tax 401k, you put them in, you don't pay taxes initially. That grows, grows, grows. When you retire and you take it out, you have to pay taxes. Okay. Roth, if you get in a Roth, it's after tax dollars. It grows, 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 grows. Retire, you take it out. You don't have to pay taxes on the gains. Okay. But that's another key benefit that Apple employees should be aware of. Okay. So that is the time we have today. So I want to thank you all for taking the time to join me. And I hope this was helpful for answering your questions, helping you understand 5 steps you need to take if you want to make the most of your Apple RSUs. So thanks for taking the time, and I will see you later.